Hello, my name is Mama Anan Hafiz bin Bahrain. Call me Hafiz. I am from Group 1 of Personal Social Responsibility, and I'm here to present to you all the Financial Planning and Management, which is the Chapter 10 of Form 4. Financial Planning and Management, what is it? It is a process that involves managing money from sources of income into savings, expenses, protection, and finally, investments. This topic is to help us understand the value of financial planning and managing our money for our future so that we can be responsible for our own problems. Five steps in financial management process: setting goals, evaluating financial status, creating financial plan, carrying out financial plan, reviewing and revising the progress. These are the 5 steps that we will be looking into for financial management process, which is the next slide. Setting goals. First step to financial management process, it must be prioritized and be very specific. Our goals: short-term and long-term. It can be achieved in less than a year. Short-term financial progress do not involve a large amount of money, for example, purchasing a laptop, furniture, a cell phone, and others. A long-term financial goals, it usually takes more than 5 years to achieve, and long-term financial goals involve a large amount of money, for example, children's education, medical expenses, and or a down payment for a house. SMART. Yes, SMART. We use SMART to have a basis of the concept for our spending in order to achieve the desired financial goals. Specifically, S is for specific, M for measurable, A for affordable, R for reliable, T, time bound. What does this all mean? We'll look at an example next. So state the financial. This is a question that I want to present to you all so we can have a clearer view of what is SMART. Jimin wants to buy a set of sofa which costs 4,000 ringgit. He aims to buy the sofa within 8 months. Jimin needs to save 500 ringgit from his monthly income of 3,500 to achieve his financial goal. Is Jimin financial goals is using a SMART approach? Yes, we can use a SMART approach to bypass this fault. Specific: buy a set of sofa. How much can we measure the set of sofa? It costs 4,000 ringgit and it requires a monthly saving of 500 ringgit to achieve the goal. Is it attainable? Yes, can achieve a monthly saving of 500 from a monthly income of 3,500 ringgit if we do it in 8 months. Realistically, this is quite important in our day-to-day life. 500 ringgit from monthly income of 3,500 ringgit is 14.29% of his income. And then, is it time bound? 8 months is enough to raise 4,000 ringgit with a month saving of 500 ringgit. 4,000 ringgit with a monthly saving of 500 ringgit. So this is basically the basic way of using SMART, because it helps you plan things out and be very specific with what you want. Going on to the next topic, evaluating financial status. Assets and liabilities are a benchmark for evaluating our financial status. Evaluating it also helps us measure our performance in the effort of achieving our short-term and or long-term goals. Example: assets has a value or benefits, or it could be both. Valuable things that you own, i.e. cash, saving, real estate investment, fixed deposit, unit trust, or company shares. This likely has something to do with generational wealth, or things that you've done in the past that can give you more and that could be considered as assets. Liability is something that you owe money to, like banks and credit cards debt, otherwise known as financial obligation. Something like outstanding payment too is a liability, like outstanding rent, outstanding credit card payment, debt, loan, and stuff like that. You do not want that to be a liability to you, especially when you're trying to save up your financial goal. So, third step, creating a financial plan. A financial plan, number 1 is define the short-term and long-term goals. Make an initial budget to achieve each goal, and then calculate monthly savings needed to achieve the short-term and long-term goals. Analyze spending behavior so we don't spend too much or and spending too much rather than too little. Spending too little will help towards our goal, but spending too much would hinder our goal with the time bound with the time bound rule in SMART. Set a time frame to achieve each goal. And last of all, determine the income strategies that will help to achieve the financial goals. The sources. The sources of income or expenses that minus or plus your financial goal. Active income, actively doing something, i.e. a job, salary, or commission to achieve that income. Passive income, earning a regular income with little to no effort, like renting a place for someone, so you can get regular income from that, interest received, or dividend from your bank, and so on and so forth. So another thing is fixed expenses. This minus your budget, which is expenses that must be paid or spent, like rent, insurance, or loans. This also goes with liabilities, variable expenses that will change every month according to our spending behavior. This is very much key to our end goal, like petrol, groceries, electricity bills, and payments. Of course, total income can be more or less than total expense, could be equal to a positive or negative cash flow. So I've already put this together, but long term can be like moving to Japan, maybe building a hotel for a family business, having a baby. Short term is something more or less like getting a phone, a PS5, or so that is a short-term goal. Fourth step, carrying out financial plan. Carrying it out, it turns the financial planning into an action that can be implemented. When carrying out a financial plan, we must follow the plan at an early stage. Then we must be ready to change and compare the planned monthly expenses and actual expenses. Example question to feed into the carrying it out is Irene received an active income of 3,000 ringgit and a passive income of 600 ringgit. In a month, Irene also incurs fixed expenses of 1,600 a month and variable expenses of 500 a month. Calculate Irene's monthly cash flow. Explain your answer. Explain Irene's cash flow if her passive income does not exist and total expenses also increase by 50%. So let's do a simple question. Irene received an active income of 3,000 ringgit, right? And income of 600 ringgit in a month, a passive income of 600 ringgit. So it total ups to, and then the fixed expenses cost around 1,006 and the variable expense of 500 ringgit. So let's calculate that. Cash flow equals to total income minus total expenses. So 3,000 ringgit plus 600 ringgit minus 1,600 ringgit plus 500 ringgit equals to 1,500 positive cash flow. We can then invest this money and use the money and save it for the future emergency situation, or otherwise we can use it for other specific goals that we want for the short-term goal, or we can just put it for the long-term goal. And I explain Irene cash flow if her passive income does not exist and the total expense also increases by 50%. Cash flow equals to total income minus total expenses. Remember, 3,000 ringgit minus 1,050% of 2,100 ringgit, it equals to negative 150 ringgit negative cash flow. She might end up using her credit card or loan money to solve the financial problems, which then becomes a liability to not help her in future situations. The fifth step is review and revise progress. Reviewing and revising the progress of financial plan from time to time is important to make sure the cash flow is always positive. This indirectly helps us to achieve our financial goal as planned. Evaluating our feasibility of both goals, long-term and short-term, an effective financial plan should be set aside of 10% saving on the total income prior to engaging any fixed and variable expenses. If there is a negative cash flow, we should adjust the financial plan by reducing the variable expenses. And that's all for Form 4, Chapter 10. Thank you very much for watching.